So nobody's commenting.
Yep, we can hear you fine.
Oh, somebody said that?
Yeah.
Oh, yay.
All right. It's good to see everyone. This is our first live stream, and we didn't know how to do it, and we're learning. But bear with us if there are any technical issues that might show up. I wanted to open the universe of questions to people who have not yet been interacting with our group, who haven't yet taken the course, or who may have peripheral interest in what we do. But the main point is I want to get knowledge out about the markets. I want to get knowledge out about the present situation in the markets. And I also want to find out where everyone is at, what they're thinking in terms of what's important to you and what you feel could be helpful in terms of improving your financial situation, in terms of your trading, in terms of your investing strategies. This is kind of a two-way street here where I want to get feedback from everyone who's interested in this field to design something that suits the demand that's presently out there. Okay, so welcome. It's 11:27, and we have been investigating the S&P market for No, you don't need to do that. I can see the questions. There.
You can see the question.
Oh, yeah. It's quite easy to see.
You can see. All right.
So I have a simple question. What is the most important thing you need to know right now about the stock market? Anybody have a question you could ask that's related to the important, relevant information that's on your mind?
Go with whatever questions you see instead of asking people to ask questions. Don't sit there.
Okay, so we've been talking about the trend of the long-term market, and we've been done about 70 videos now on YouTube describing last year has basically been a down year, and 2023 we're expecting to reverse that downtrend and turn back into an uptrend. And the primary thing that most people seem to care about is, are we still in a bear market? And if so, when is the hammer going to fall? And at this point, the long-term story is that we are still probably in a very long-term secular bear market that will reflect similar structure to other bear markets, which start out going down, and then they have a middle section, which is going up, which is where we're at right now. And then the last section, they tend to collapse and finish dramatically with some sort of a C wave. But the thing is that this could be a 4-year pattern. In other words, the first year is 2022, and then 2023, 2024, and 2025 could be the down year, or even 2026 could be the final low in this process. So 2023, without violating any Elliott wave rules for the structure, could easily be an up year, and we're still in a bear market, and it's called the bear market rally. And it even could gyrate and continue higher into the late part of 2024. Now, the analog to that would be the 1962 market has been about 95% repeating in the last, since 1961, 1962. 1963 is still right there. 1964, 65 went up, and then finally we had a decline in 66. Similarly, there was a bear market structure that started in the crash in 1987, which is had a 1984 was a down year, 85 and 86, and most of 87 were up, and then it crashed in one day and reverted back to a lower price than we had in 3 years. And that's the type of structure we're looking for. Okay. So basically, we're looking for a rally phase in 2023. We're looking for it to get going in June, July, and then possibly rally until October. There is a chance that between October of 2023 and April of 2024, we could see another big break. And that big break would not be long lasting, but it could be much like the pandemic break that we had in 2020, where February and March were killer, 20% down. And then rest of the year, it just rallied. In the same way, we're looking for possibly some gyrations after October of this year. Some nastiness could come back in. We could see a very big shakeout between October and April of 2024, October of 2023 into April of 2024. And then the 4-year cycle will continue. Expect to see the late part of 2024 go back up again. So until July of this year and probably October of this year, we'd expect to see an uptrend in general. Okay. Before it starts, though, we're still in kind of a congestion phase where the market congested. It went down in February. We called for a low in March 2nd, which seems to have come in. Took off yesterday, took off again today. My expectation is next week. The question was, what's going to happen next week? I think it'll come back down Monday and Tuesday, and then rally after the 8th or starting on the 8th and go up into the 20th through 22nd of the month. And then that will be the end of this rally phase, which will be followed by another decline phase that should be meaningful, possibly bigger than February, and go on until May 3rd. Okay. My most recent video saw there was clearly a 2-month cycle in the market. You had a high and then a low a month later in October, a high in November, a low in January, a high in February, a low in March. It's had 7 consecutive hits where the swings were correct and the market ended up going down exactly where we had expected to until the first week of March. And short term, there could still be one more little dip before it's ready to go. And that could be Monday or Tuesday of next week. So that's the short term picture. Now, the next 3 months, Nick Hale wanted to know, we're looking for, again, a rally until late March, a decline until early May, and then the beginnings of a very strong rally that should go into the mid to late July area, maybe very dramatic. Some of the patterns seem to indicate that there's a high in July, which is represents a very sharp upswing that starts in June and moves up strongly into July. So that will be where the bullish pattern really is visible, because until May 3rd, we're not expecting to see it. If anything, we're probably going to see more declining after the March 20th point. Okay, let's see what else we have. Oh, yes. We have one of our students who was very clear about the seasonality in the markets. Apparently, 85% of the money that can be made in the stock market is made between the 28th of the first month and the 6th of the following month. If you look at a month of 30 days, from the end of the month until the 6th of the next month is where most of the up moves are happening. Right now we're in that, and you'd expect therefore to see a rally up into Monday. But I think the rally this time will, after a little pullback on Monday, probably go up further in the month and have a retest of the high area, which was around 4,200 on the S&P. And we'd also expect to see it may stop around 4,100 if the B wave is wimpy. So after 4,100, there is a little bit of risk. It may not go higher. But let's see what else we have. Nice call the other day. Constantine. Yeah, it's great, having interaction with everybody. And I'd like to get to know you all over time. That probably will happen. I want to share with you that I wished to put some videos up that include pictures of the what we call the matrix. There's a channel matrix structure, invisible structure in the markets, and it's something that I've discovered. It's based upon the work from Bomring and hi, Roy. And we're very, very happy to um, give updates on this structure in our weekly on our website. Each week, I'm going to update the matrix structure. And this unmanifest matrix, nobody knows about it. It's not drawn from trend lines. It's not drawn from moving averages. It's not drawn from Gann lines. It's something that just is remarkably interesting. And what's interesting about it is it has nothing to do with the market. Those lines are lines of force. They're kind of like underneath the surface of life, and they're there before the market gets there. And what's interesting is oftentimes when it hits those lines, they become resistance. And you can kind of tell the strength of a market by how it handles those lines. You know, if it comes down to like we reached one of them on Friday, on Thursday. It was an upsloping line. It came down to the price of the thing, and markets bounced up since then. And until it breaks that line, that uptrending, we call it a channel because they're parallel to each other. There are multiple kind of quantum levels of the same thing. They represent support and resistance levels. If they're broken, then it means the market generally has some strength or weakness that's unusual. Okay, so you can use those to gauge additionally, along with whatever else you might be using to gauge strength and weaknesses. Um, Bob wants to know how much of the monthly profit was made between the 28th and 6th of each month. The answer was, from what I've been told, is 85%. 85% of the money that's available to be made is made during the first week of the month every month. And it may not be every month, but on average, that's where the moves are taking place. So it's quite impressive. Cycles on farmland or 30-year mortgage rates. Okay. So we looked at the treasury bonds, and it's looking like the treasury bonds are going to be in a decline until May. And then after that, there could be another rally in the bonds, which means that interest rates should stabilize and settle down some, at least into next year. We are looking for, again, remember, we're looking for an S&P breakdown between October and April of next year, which would indicate that at that point, there could be a reversal in the bond market, which is, again, to reestablish an uptrend. So if you want to wait until next April or so, that's the beginning point where you're probably going to see some sort of a decent rally in the bonds. But until then, it'll go up and back down again. All right, what else we have here? Farmland. It's same thing with farmland. You know, farmland over the last 50 years has been trending higher in general, and there's a finite amount of it. And the prices of farmland are probably going to continue to be very high. Interestingly enough, this is out of the box of what you're used to. There's a great analog between the United States history starting in 1776 and the Roman Empire starting around 27 BC when Augustus became the first emperor. And there's a very strong, it's a 1768-year cycle that I've been studying and watching and looking at. And in Rome, around the time we are now, so about 1800 years earlier, there was a massive period of inflation. It didn't yet start. What we saw recently was not it. There still could be a settling down of inflation over the next few years, and they may have, the government may actually find a way to kind of cool it for a while. But in Rome, the value of wheat went up 1,000 times in the next 100 years. The price of farmland is going to go through the roof, but it'll take a long time. I mean, this is a massive, huge, giant cycle. Okay. If you want to invest in anything, Wall Street is not the place. Agriculture is going to be the place to put money over the next 10, 20, 30 years. It's something that very few people outside of the Midwest are doing, but that's it. Yeah, 1,000 times. So buy some land somewhere and hold on to it and give it to your kids and let them give it to their kids. There's also a question what inflation will mean. Will $1 million buy a bottle of milk? At that time, that's a very good question. But inflation is natural. As long as it's not rampant out of control, the prices have been going up forever. Usually, there's a relationship between the population and the population growth, and the requirement for more food and the requirement for more housing, and therefore prices tend to go up. And they generally go up in a gradual way, and that's natural. What's happened is that imbalanced in this world is that the salaries haven't gone up commensurate with it. In other words, the stock market has been going up for since 1982. It went up from 777 on the Dow to 35,000. The increases in wages are about 4 times. So there's a 25 times differential between the amount of money that you would have made in the stock market and the amount of money you would have had in your paycheck. Ergo, it's squeezing the middle class out of existence and such. And that's an unfortunate part of what's happening. But these things tend to balance out. As a matter of fact, they've balanced out numerous times. In the last 800 years, there was a book written. It's called The Great Wave. The author was a Brandeis professor, and he basically studied the prices of items that people had to pay over the years. And there were 4 swings of huge inflation. And he even measured the price of a suit of armor back in the 1300s, for those who care. And we're in a phase now where we're kind of the end of this explosive phase where, the money's going to the top, and 1% of the country has 90% of the assets, and the rest of this. That usually ends with a crisis. The pandemic may have been the beginning of a crisis period that's going to kind of level the playing field somewhat over the next 20 or 30 years. And this period, it started roughly 1896, and it should be ending around now. Over the next 50 to 80 years, there should be more of a balancing out in the overall structure of the societal imbalances, so that generally the middle class will start to rise up, and there'll be more of a balance in terms of kind of more availability of money for a larger percentage of the population. Of course, the stock market at some point is going to have to collapse in order to create that balance. And I don't think it's going to happen anywhere near now. I think it'll be, as Marty Armstrong is thinking and others, I think it'll be about 7 to 10 years from now before the market is going to be in a position where there's a global massacre. It will eventually happen. And I think the low is going to come in somewhere around 2020, 2042. And until then, the market will go up, it'll go down for a couple of years. It'll work its way higher into 2025, and it'll go back down again and then up and down. But it's like the 60s, If you look at the 60-year cycle, it's a great analog. I mean, it's been working for a long, long time. The 1949 low in the stock market, 60 years later, is 2009, right? And what happened after 1949 is the market went up. And it went up into 1966, and then there was another high in 69 and another high in 73. So if you look at that and you add 60 years to all those pivots, you get a high in 2026, a high in 2029, a high in 2033, and 2033 lines up with that huge decline that we had between 1973 and 4. And that, of course, the market really didn't go up until 1982. So there was an 8-year period where it collapsed and stayed down until 1982. Now, what's interesting is 2033, if it's the analog of 1973, it's also extremely close to the tulip mania that happened in 1720. And for those who care, there's a 314-year cycle, pi times 100, in the markets, and 1720 plus 314 gets you to 2034. So 2034 and 2033 are within a year of each other. there's a very good chance that's where the highest high and the most disastrous decline will take place. And until then, the market will gyrate. It had a huge amount of gyration in the 60s. It had a high in 62, fell hard, came back up to 66, fell hard into 67, and went up to 69, came down into 1970. And these were 30 or 40% declines. The last one from 73 to 74 was 50%. So a 50% correction in this stock market from a 40,000 starting point, which we didn't get to, would take us back to 20,000 again, which is where we were in 2020. So let's see what else we got. Hello, hi Max. Wonderful knowledge. All right. What are some of the favorite books or databases for finding asset prices and trends prior to 1800? Well, there is one called The Record that you can get, and there are a couple of companies actually online that archived long-term economic trends. Offhand, I can't think of their names, but if you research on Google, you look for long-term economic trends, and you'll find several companies have archived those dates and those prices. Jerry Bomring, who was my mentor and who was a bit of a wild man, he traveled to England to the British. There was the major library in Cambridge, and he found wheat prices back to the year 1200. So the data is available if you look for it. Now, it's interesting, it's not cheap. I tried to get data on various oil-related products, crude oil and butane and such, and fertilizer prices. You have to pay a lot of money for those things because they're rare, and the people who hang on to them, they decide to make a business out of it. Do you have a forecast chart for the rest of the year? Yeah, Nikhil, I'll put it up, but basically it's the chart that we had shown, the analog of the 1934-35 stock market. There's a low in May, and it rallies strongly until October. It may not be as strong as that market was. It was dramatic, but there is a good chance that we're going to see a more bullish year than almost everybody expects, because the economy does have issues, and there's good reason for the market to be going down. And it will have some breaks. I mean, the one in April, the one after the 22nd of March, we're expecting to be fairly meaningful. But the trend is not down anymore. The trend will be, all of these things are shakeouts. They're for the purpose of getting the bulls out of the market. And then you'll have opportunities to be buying in May, as opposed to selling in May and walking away. It's going to be buy in May and hold till October. That's just an interesting statistic. Okay. What charting software do I use? I use TradeStation. And I have some custom ones that my software, I have, my own code that we wrote. And we have data that comes from other places as well. Navigator is one of the programs I use. It's a Colorado-based program, and they have data back on the Dow to 1901. And so that's useful in terms of analyzing the longer-term stuff. Okay. Any other? Let's see what else we got. Okay. So I wanted to just bring up what we're doing in terms of, my company, and what we want to do is we want to teach these courses, and most of you have taken or are taking that course. And we want to offer as many people that opportunity to really fully, thoroughly understand the mechanics of the markets. To be able to forecast the future is the best way to remove the risk from your trades. There's always some risk. You could be off by a day on your cycle, high or low. But if you know the general idea that the market's going to go down for 3 weeks, or it's going to go up for 4 weeks, and other people who are trading using moving averages and such, they're always behind. They're always lagging the situation, and they're guessing at the future, and they're thrown off the track very easily when the market shakes you out in a bed. It has a down day in the middle of an uptrend. So it's a very, very powerful level of knowledge. There are different levels of knowledge, It's like that in everything. And the most superficial level is just watching the price action. You see it go up, it looks like it's going to go up. You see it go down, it looks like it's going to go down. And the price action is extremely deceptive as well, because it means nothing really in terms of developing. If you look at how to determine a trend, all right, if it goes up, up, maybe that means there's a trend up. And if it goes up, down, up, maybe you have a 5-wave Elliott wave pattern. But the point is, it's still very, very limited information can be gleaned. You don't really know if there's strength there. You don't really know if there's weakness there. You don't really know who's buying, how much buying is going on. So that brings you to the next level, which is what's the internals? The internals, I like to use the analog of a blood pressure. You know, you look at somebody, they look healthy, but you take their blood pressure and it's 180 over 100, and you wonder why they're walking around, you know. In the same way, the volume is one of the best measurements that you can have, because it tells you buying pressure is the basis for price action going up, and selling pressure is the basis for. So if you can measure it, then fine. But it isn't all that easy to measure, because you don't know, not just because the volume is high on a given day doesn't mean that that's all buying pressure, right? So then up down volume is a more subtle level of measurement of internals. So that's another level. Then the money flow, if you can tell if the professionals are buying or the public is buying, it tells you where the market's going to go. You basically want to follow the big money, but you need to know where the big money is. You need to know the size of these orders, whether they're small or big lots and such. And there's software available to do that. A third level, a deeper level than that, is sentiment. When you look at the public versus the professionals, when the professionals are generally buying is what you want to be doing. However, it's not always true. For example, in the 2009 low, for those who, everybody was, you know, mangled for the most part by that decline, with the exception of a few day traders. The 99% of the public on March 6th of 2009 was bearish and thought the market was going to go lower. What people don't know is that 98% of the professionals were also bearish. It's only a handful of people who had the, whatever, you call it guts, call it what you want. They actually had knowledge. They saw that low might be related perhaps to the 60-year cycle low in 1949, right? So that was, the sentiment is an important thing, but knowing what the commercials are doing, what the miners are doing, what the companies who are actually invested in the raw materials that create things, they're likely to be the direction. So having information about the sentiment on that level, and the real who are the buyers? Are the commercials buying? Are the hedge fund managers buying? Are the public, is the public buying? Knowing that's a deeper level still to get information, but it's still not precise about the time. Time is the deepest level. The information is the most invisible. Nobody feels time. Nobody sees time. And yet you can track it when you draw the graphs and you see there's some sort of a cycle, you know. But cycles aren't all smooth sine waves, you see. So what we're teaching ultimately is how to locate these cycles, how to locate these rhythms, and understanding that these rhythms are structures that are not necessarily smooth sine waves, which radio waves are and which many other vibrational frequencies are. And W.D. Gann's law of vibration, and he also called it the law of periodicity. This is what we teach. And we teach people how to locate pieces of the past that are likely to repeat in the future. So that's good. And this is for the people who really want to get it, who really want to understand, who want the knowledge. But not everybody wants that. A lot of people just want to know how to make money. You know, they want to buy a software program, let the computer do it. You know, they want an ATM machine that the trades are made by the computer. They can go on vacation and just collect the profits. There is also, I'm going to try to appeal to or give out some techniques that people can use, systems that people can use. And one of them we have is the Ikimoku cloud system, which is a great system. It's something that was designed by, you know, a Japanese fellow, Mr. Hosata, in 1960. And it was used in Japan for many years, from the 1970s and 80s. In 1990s, it moved over to the United States. But the thing is, it was developed basically for inputs that were effective on the weekly scale, weekly data, weekly bar charts, and it worked pretty well. But on the daily, I noticed it didn't work quite as well. On the hourly, it didn't work. Was even less effective. So what I did is I updated the inputs. We went through, we coded a software program that can measure the effectiveness of different inputs. And I went through probably, I don't know, maybe 10 or 12,000 different combinations. We found some really good ones. And the one that we found that was the most consistent, we're teaching that. We're selling that in the course. And that's for people who just want to be able to find out when, where the signals are to buy, where the signals are to sell. But then on another level, then some people don't want to learn anything. They don't want to study anything. They don't want to draw a line on a chart. They just want to know what to do. And so I'm also selling signals. And we're doing it now. It's very difficult technologically to get it out there. We have signals that I have systems that generate as many as 20 signals a day, but to transmit that information without problems is extremely technically difficult. Consistently, there can be breaks in the internet, there can be breaks in the electricity. There is too much error potential to automate that at this point. We haven't found a way to do it. So I'm doing it first with a more longer term trading system that works. It's been working really well for the whole history of the S&P. Most better since 2007 or so. It's been even better. It had a couple of losing years, but in the last 10 years, it's been doing very, very well. And it's not just because the interest are going down. It made money when the interest rates were high also. But and it gives signals roughly, twice a month. Sometimes they last 3 weeks. Sometimes they last 1 week. And I started, we have one it's called the 12 wave model. It's based upon 12 cycles added together. And when 7 of them are up, or 7 or more are up, you go long, 7 or more are down, you go short. And it's been making consistent money for a good deal of the history of the S&P. And that's something that we are offering that now. And it's inexpensive, but it's something that for people who just want extra support for their trading, it's a good bet. Just went long, by the way. Anyway, so I want to invite everybody we'll probably have more of these live streaming things. And when we get the technology down, we'll probably get it into a format where you can actually speak and I can hear you. But this is our first effort to do it. And how can you purchase the signals? Go onto our website. And our website is located, there's a link on our YouTube that describes the website. It should be available there. Lori?
Yeah.
What's the website name? This shows you what I know.
Trade Forecast Mastery.
It's called tradeforecastmastery.com. And in there you have a lot of the things that we're discussing, including this matrix updated weekly, which I think you'll find intriguing. Can you purchase it? Can you provide the description, please? Yeah, on the website, there's a description of the system in great detail, year by year, the results. These are hypothetical, by the way. I traded it part of the time, but I haven't been trading it for 20 years. But the model has been particularly good since the prices of the S&P have gone up so much. When the prices got higher, the system seems to be more happy. It's making more money than it ever did. So I thought it was intriguing enough and potentially valuable for people now. Let's see. Website address description. The website address description. Okay, let me see if I can do chat on this thing. Can you type it in, Lori?
It's there, Alan. Trade right above it. Trade Forecast Mastery, right above it.
It's right above. Oh. Okay. It's tradeforecastmastery.com. It's right above. And so that's going to be the beginning of kind of an ongoing process of bringing out this knowledge. And it will be something that will get enriched with additional products and things. And you have to understand, I have 26 algorithms that I've developed, and since 2007, um, I have a partner in Kansas City, and we developed uh, relationships with numerous very, very large commodities firms, and I've been giving weekly reports to them for years and years and years, basically, and they pay a bunch of money for that. It's not cheap. So I didn't do anything with the public until recently, but then the pandemic came around, and you got all these kids getting online who know nothing about the markets, who have whatever money they have, they're about to lose it. So we felt like, okay, it's a good time to start getting some of the stuff out there, some of the algorithms out there. Some of them require software that I can't transmit easily, and you need to have, there are DLLs that are very large, and it's complicated. But the easy ones that are easy to describe and easy to use, those are the ones that are coming out first, and I'll continue to bring out more. If there's demand for them, I'll bring out more. It's a question of how much interest there is out there for professional quality trading systems. All right. So I thank everybody. It's now noon, and I don't want to take your whole day away, but thank you for being here for the first of our live broadcasts, and there'll be many more, and we'll give you a little more notice next time. And we'd love to get further input. And if you want to leave some input on our website or on the YouTube channel describing your thoughts about this and anything else we can do.
What do people want?
Yeah, and that's right. So what would you find is useful? What would you want from our service? And if there's any way to do it, and it's legal, I can't give away certain things. And I'm not gonna be able to give you specific signals, and I'm not trading everybody's money. That's not what we're doing here. But I want to teach you how to trade yourself and how to make money, and give you some tools to do it, and also have some potentially trading systems available that you can use. Do I give your customized software to the students who participate in the course? Yeah, we're going to do that with the Ikimoku. As soon as I have developed a model that you can use, you just send a little email on TradeStation, and the code it works. The more complicated stuff, I can't even do it easily. You'd have to be an expert computer person to handle it. But yeah, and the Ikimoku course, we're going to have a version without the software, and it'll be more expensive, but with the software as well. And that's coming up quite soon, because that software seems to be transmittable. I can send you an email, and you can use it on TradeStation. You need to put a few inputs in it, but once the inputs are in there, it works. All righty. Any other questions? And if not, have a great weekend. Service where you can send us daily trading signals. Now that's important. I have some, really good shorter term systems. However, we have not yet found a way to get them consistently to you, because I'm in the Midwest, and our equipment is not, the internet here is not as good as it is in Chicago. We're trying to maybe work with a broker or some company in Chicago who has 24-hour, where somebody's there 24 hours a day and can send the signals. So a lot of these signals come at night. Some of them come at night. Some of them end at night. I can try to isolate systems that only trade during the day and get out by the end of the day. But at this point, I don't have that available. It will be available as soon as we figure out how to do it. Your YouTube video. Okay. How long will it take to learn and master your course? The primary course, the forecasting market course, it's a 4-week course. and it's 2 hours per week for 4 weeks. And then we have 2 months of what we call a clinic, where you have 1 hour every week where we discuss and answer questions and review individual charts and review and integrate. And so you really master the stuff. So think of it as a 3-month program. And the first 4 weeks is kind of more me teaching. But also we have the videos for each Zoom session are available. And they're 2 hours per week. And then yes. And the videos are available. And then the clinic is 1 hour per week for 9 weeks after that. And that's part of the package. I want you to try to actually master this stuff before you walk away. Okay. All right. On that note, I want to thank everyone for being here. We'll catch you next time. Have a good week and enjoy your weekend. Thank you.